Imagine for a second having $10 million in cold, hard cash. Sounds pretty amazing, right? Well, that is until you realize it weighs over 200 pounds, and you have absolutely zero ways to actually spend it without raising some serious eyebrows. And that right there is the ultimate criminal dilemma. Dirty money, no matter how massive the pile, is virtually worthless if it can't be used.
Welcome to This Explainer. Today we're diving deep into the mechanics of financial legitimacy. We're not just talking about the old cliché of stuffing cash into a mattress either. We're exploring the highly sophisticated global manufacturing of legitimacy. It's a genuinely fascinating look at how the darkest corners of the economy try to blend right in with the brightest.
So here is our roadmap for today. We'll start with the usability problem. Then we'll walk through the three-stage playbook, take a look at the AML defense framework, and finally wrap up with the evolving financial threat.
Let's jump right into Section 1, the usability problem, also known as the criminal's dilemma.
To really grasp the mechanics here, we absolutely have to start with the official definition. According to authorities like the FATF, money laundering is the process of disguising the criminal origin of illicit funds so they can be used as if they came from legitimate sources. Basically, it's the essential bridge between the crime itself and the actual payoff.
Now, take a look at the sheer variety of crimes that generate these illicit proceeds. We are talking about massive global enterprises built on fraud, corruption, drug trafficking, tax crime, cybercrime, and market abuse. These serious offenses generate literally mind-boggling wealth. But here's the catch. Those proceeds are effectively trapped. They are completely useless to the criminal if they remain visibly tied to the original crime.
The biggest misconception out there about money laundering is that it's simply about concealment, just, hiding cash from the cops. But for professional networks, it's actually all about usability. Criminals have to convert their dirty proceeds into wealth that can be openly spent, invested, transferred, or pledged. They need to create a flawless, airtight illusion of legitimacy.
Which brings us to Section 2, the three-stage playbook, specifically the UNODC model. The United Nations Office on Drugs and Crime actually outlines a classic three-stage playbook used to wash dirty money. Those stages are placement, layering, and integration. And while these steps often overlap in the real world, they give us a perfect step-by-step framework for understanding the exact mechanics of this financial magic trick.
Step 1 is placement. This is the moment illicit funds first cross the threshold into the legitimate financial system. The ultimate goal here? To sever that immediate, glaring association with the crime. This could look like physical cash deposits, buying monetary instruments, or funneling money through cash-heavy businesses. But make no mistake, for the criminal, this initial point of entry is almost always the riskiest step of the entire operation.
Once the money successfully breaches the system, we hit stage 2, which is layering. The goal now is to make the digital audit trail as utterly confusing as humanly possible. Criminals will rapid-fire funds through multiple transactions, bounce them between various accounts, funnel them through shell entities, and constantly cross international borders. They are intentionally creating a dizzying, complex maze just to baffle any investigators trying to follow the trail.
And finally, we arrive at Stage 3, integration. After successfully navigating that crazy maze, the funds reappear in the criminal's hands looking perfectly lawful. It might show up as seemingly legitimate business income, clean investments, or proceeds from a property sale. The transformation is complete, and the wealth is fully integrated and ready to be openly spent.
Moving on to Section 3, the AML defense framework, where financial institutions are on guard.
Flipping the script for a minute, the central danger for banks and financial institutions is unwittingly becoming the very channel for that placement or integration we just talked about. And this usually happens when an institution has weak internal controls, things like poor customer due diligence, a glaring lack of transparency around who actually owns a company, or just completely ineffective transaction monitoring.
Regulators mandate strict systems to prevent exactly this from happening. Essentially, it requires banks to step up and act like detectives, piecing together a massive puzzle. A professionally mature anti-money laundering framework doesn't just, tick off compliance boxes. It focuses relentlessly on several deeply connected questions.
It starts with these fundamental diagnostic questions. Who is the customer, really, and what is the exact purpose of this relationship? A bank has to establish a solid baseline of expected activity. Think about it. If you don't fully understand why a customer opened an account in the first place, you are definitely not going to recognize when they start abusing it.
But the interrogation has to go deeper. Do the ownership structure, the source of funds, and the actual transaction behavior make sense together? Investigators are actively hunting for unexplained changes, the sudden involvement of high-risk jurisdictions, rapid pass-through movements where money just bounces in and immediately out, or highly complex structures that completely lack any real commercial rationale.
This distinction right here is exactly why some defenses fail while others succeed. Money laundering absolutely thrives when banks only look at fragmented, isolated data points, like just verifying a name or an address and calling it a day. A truly successful AML framework takes a step back and assesses the coherence of the overall picture. Does the entire financial story make sense? If the puzzle pieces don't fit together naturally, the system absolutely has to trigger an alarm.
Now for our final segment, Section 4, the evolving financial threat. We are moving way beyond the cash suitcase.
The days of purely cash-based laundering are, for the most part, completely behind us. Modern criminals are highly sophisticated and they adapt right alongside global finance. They exploit a massive, ever-changing variety of channels, from global payments and correspondent banking to incredibly complex corporate structures, securities activity, emerging digital assets, and the strategic use of professional intermediaries. The threat has evolved far, far beyond those old-school, traditional cash-in-a-suitcase schemes.
Take trade-based money laundering, for example, which is an area heavily scrutinized by regulators right now. This involves moving value through international trade transactions, like wildly overpricing a shipment of cheap goods just to legitimize illicit origins. It manipulates global invoices and shipping routes, proving exactly why effective controls must be highly adaptable to real-world risks and not just rely on rigid, outdated rules.
Bringing this whole explainer full circle, money laundering is not just some niche criminal law concept. It is a profound, central threat to the entire global economy. It is literally the core problem that AML frameworks are designed to prevent, the transformation of illicit wealth into apparently legitimate value within the financial system. Every single institution that handles transactions or market activity is right there on the front lines.
Which leaves us with a critical and honestly somewhat unsettling thought to ponder. As our global financial systems grow increasingly digital, borderless, and overwhelmingly complex, are our defensive puzzles simply missing a few pieces? Or are we just looking at the completely wrong picture entirely? Thanks for joining me for this explainer. Keep questioning the big picture.